Welcome back to the StoxCompare Explainer. Today, we're putting on our equity research analyst hats and forensically breaking down the numbers to figure out what is actually going on with Lucid Motors in 2026. Look, if you've been watching the ticker lately, you know it's been an absolute roller coaster. But as always, we're not here to trade on emotions. We're here for the hard data.
We're slicing straight through all the market noise today to answer the million-dollar question for retail investors. Is this stock a genuine, fundamental turnaround story, or is it just a perfectly disguised bull trap waiting to catch your liquidity?
So let's put this into context right out of the gate. Recently, the stock caught fire with a massive 42% bounce that literally had retail traders buzzing everywhere. But you absolutely have to zoom out. When you look at the wider lens, we're looking at a brutal long-term collapse. The stock is down 33% year-to-date, down 79% over a single year, and has suffered a staggering 97% value destruction over 5 years. That's a classic setup where short-term momentum completely masks long-term decay.
Now, what actually caused that wild 42% spike? Well, it was a direct reaction to extreme market fear abruptly followed by massive relief. We had the July 2026 bankruptcy rumor, driven by reports that AlixPartners had been retained for a Chapter 11 review. And man, this triggered a huge sell-off and multiple trading halts. But then came the rebuttal. CEO Silvio Napoli firmly denied the rumors, called them completely false, and clarified that AlixPartners was hired strictly for operational guidance. He also confirmed their liquidity extends well into next year. The market exhaled and the stock popped. But remember, a sigh of relief is definitely not the same thing as fundamental growth.
Section 1. The Forensic Financial Breakdown. Let's do an operational reality check.
At first glance, there's definitely an illusion of top-line success here. Revenue is expanding beautifully, scaling up from just $27 million in 2021 to an estimated $1.35 billion in 2025. It sounds like a fantastic growth story, right? But actually, this top-line expansion is masking some severe operational headwinds. They've missed Q2 delivery estimates, they've completely suspended production guidance, and they're battling an elevated inventory crisis. Because building cars is one thing, selling them profitably is a whole different ballgame.
Which brings us directly to their liquidity crunch. And the cash burn reality is just stark. Their cash and equivalents are draining incredibly fast, plummeting from a healthy $6.26 billion in 2021 down to a dangerously thin $1.63 billion modeled for 2025. Meanwhile, negative operating cash flow has worsened to roughly $2.93 billion, and negative free cash flow is just steadily bleeding out.
Which brings us to the absolutely crucial metric, negative $3.8 billion. That is their 2025 free cash flow burn. Just stop and think about that for a second. They are burning $3.8 billion in a single year, but their total remaining cash reserves are only $1.63 billion. The math literally does not work without massive ongoing external capital injections.
Now, you might argue, hey, they're getting more efficient. And technically, yes, they are. Gross margins have progressed from a catastrophic negative 471% back in 2021 to a slightly less catastrophic negative 92.8% in 2025. But any margin improvement there is completely overshadowed by their staggering raw spend. Just in 2025 alone, research and development costs $1.21 billion. That's nearly 90% of their total revenue. Add in SG&A at $1.03 billion, and they're spending over 1.6 times their entire revenue just to keep the lights on and design future products.
To truly grasp the severity of where Lucid is sitting right now, we really need to compare the relative balance sheet health of their early public days in 2021 directly against the financial distress we are seeing modeled for 2025. When we line up the numbers, it paints a picture of intense financial strain. Back in 2021, they had roughly $1.99 billion in debt, a totally manageable debt-to-equity ratio of 1.02, and a massive $6.11 billion in working capital. Fast forward to 2025, and total debt has escalated to $2.91 billion. That spikes their debt-to-equity ratio to an extreme 7.51x, while their working capital buffer has shrunk to just $0.66 billion. They're highly leveraged, and that safety cushion is basically gone.
And what happens when a company with no free cash flow takes on this much debt? It fuels the dilution engine. This is exactly where retail investors get crushed. Outstanding shares have expanded from $0.074 billion in 2021 all the way up to $0.312 billion in 2025. That is over a 4x dilution. Your slice of the pie is getting drastically smaller every single year.
Consequently, the price-to-book ratio is being forcefully compressed from 16.02 down to 4.78, completely mirroring the collapse of their tangible book value.
Section 2. Macro Forces and the Saudi PIF Backer.
Impartially speaking, the broader macro environment is presenting some fierce, almost hostile headwinds. We're seeing a widespread cooling in premium EV demand across the entire sector. And on top of that, there's a major policy shift, the loss of the $7,500 federal EV tax credit under the new administration. This removes a massive buyer incentive for high-priced vehicles. To survive this environment, Lucid has had to implement some pretty desperate countermeasures, including laying off 18% of their U.S. workforce and heavily placing their strategic reliance on the upcoming Gravity SUV to basically save the day.
So this forces us to ask a really critical question about their biggest safety net, the Saudi Public Investment Fund, or PIF. Is their limitless backing a savior for corporate survival, or is it a safety net that effectively guarantees retail destruction?
There's a massive tug-of-war happening behind the scenes. On one hand, the PIF acts as a permanent bankruptcy shield, granting emergency capital to keep the corporate entity alive. Honestly, that's exactly why the CEO could so confidently deny those bankruptcy rumors. But on the other hand, this continuous structural equity financing suppresses the stock price and severely dilutes you, the retail investor. The company survives for sure, but your shares become worth less and less.
Section 3. The final verdict. Buy, hold, or avoid. Let's look at the final scorecard. The bull case relies on their undeniably world-class EV battery technology, the hopes pinned on the upcoming Gravity SUV release, and that virtually unlimited PIF backing. But you have to weigh that against the hard, metric-driven bear case. Negative $3.8 billion free cash flow in 2025, deeply negative gross margins at 92.8%, a dangerously high 7.51x debt-to-equity ratio, and that severe 4x share dilution. So our definitive StoxCompare verdict is that this recent 42% bounce is just a speculative trading event. It is not a fundamental turnaround. For a long-term investor, this stock is a clear avoid and a textbook bull trap. So looking at all the forensic data we've unpacked in this explainer today, I really want to know where you stand. Are you stepping in to buy the momentum of the bounce, betting that the Gravity SUV actually turns the ship around? Or are you staying safely on the sidelines to avoid the fundamental trap of endless dilution? The numbers are on the table, the rest is up to you. Keep analyzing, stay rational, and I'll catch you in the next explainer.